Underwriting multifamily is one of the most important steps you'll ever take if you want to scale your multifamily portfolio. However, there are some red flags you have to be aware of to make sure a deal is actually a deal. Today, we talked to Dr. Jason L. Williams to talk about underwriting multifamily and making sure you avoid some of the common traps that deter many investors. If you want to learn how to be a better underwriter when it comes to multifamily investing, be sure to check out today's episode of Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Now, Dr. Jason L. Williams has an expertise that spans from single-family rentals to large multifamily syndications. Now, he's underwritten hundreds of millions of dollars in deals, and he's great at breaking down complex financial data to make smart decisions. He is this founder and CEO of Ironclad Underwriting. Let's welcome to the show, Dr. Jason L. Williams.
Thanks, John, for having me.
Yeah, absolutely. Jason, it's great to have you on the show today. I went over your bio at a very, very high level. Why don't you take a couple of minutes and fill in some of those gaps?
Yeah, so my real estate investing journey started in 2003. I bought my first single family home. I still have it. I've cashed out, refied it a few times, and was able to invest in more single family homes. But in 2017, I met Joe Fairless, and he introduced me to buying apartments with other people's money or as a syndication. And like from there, I never even looked back. Just the single family homes. I've been going for that. And um, when I bought my first home in 2003, I was in grad school. I was earning my PhD in chemical engineering. I figured I'd be a chemical engineer and make lots of money, and then I would do real estate on the side and make even more money. Um, so I got my first job been at as an R&D engineer after I graduated with my PhD, and I was that for 15 years. And during that time, I was accumulating more real estate. And in 2022, my company left Wichita Falls, where I live, to Houston. And so what happened was they're like, all right, we're going to lay you off. I was already planning on leaving because I already bought my first apartment complex as a syndication as a W-2 employer and or employee. So then I was already planning on, it's like, I'll consult with you. But they came to me and said, we're laying you off. Here's a package. And then here, we want you to consult for us as an engineer or whatever. So I was like, I got everything I wanted. Got my severance package, got my time. I got to do more real estate, and I got to consult with them on the side if I wanted. So as an R&D engineer, I tested units, and these are heat exchangers, but whatever, so that the salespeople could size them and sell them based on what I tested. So I had to create systems so that we could take the data that I gathered and dumb it down so that our salespeople can use it to sell. And so I brought that skill set with me to multifamily so that I can size basically apartment complexes, dumb it down so just about anyone can do it, minimize user input. And so you get all the information you need from that. And so that's what I brought into it. And that's how Ironclad Underwriting got started, is from that skill set brought forth from from research engineer to real estate. So that's where I am now.
Jason, I'd love to hear your story, man. You talked about starting off with single family homes and looking at real estate as a side hustle, right? You had this great job as a chemical engineer and doing research and development. And real estate was a nice little side project to just continue to grow your cash flow and your net worth. And one day you meet Joe Fairless, friend of the show, also a fellow mentor of mine. And Joe teaches you how to raise capital, how to syndicate, and how to scale into larger apartments. And from there, you recognize that, hey, this is a pathway that I want to really pursue more of. Timing worked out where your firm, and you were getting ready to quit, and they were like, hey, we're about to, lay you off and give you the same package and everything that you want. So you could actually transition and focus full time on real estate. And you talked about being able to take that training in R&D and taking complex information and data and then dumbing it down a little bit so the sales folks can use it. And you kind of do something similar here in multifamily. So let's talk about that, right? Because multifamily, commercial real estate in general, I feel like for those who are new to the space or coming into the space, it feels overwhelming. It feels unnecessarily complex. There's so much jargon and, just there's so much posturing, and it's just really off-putting for someone looking to break into the space. Can you talk about how you're able to wrap your head around the complexity of it, but then also then really synthesizing it so your average individual can understand what information is really relevant?
Yeah, so there is a lot of jargon, a lot of terminology, and you and I been in the space long enough where we use the terminology and we don't even realize we're using it. So sometimes I'll say like, well, NOI, and then I'll like net operating income, and I'll take a step back so that people will understand what it is. Um, but yeah, the whole thing seems overwhelming. And when you look at a spreadsheet and all you see are numbers, it's like, oh my God, I'm getting blasted. And if you don't like spreadsheets, it's even worse. If you don't understand numbers, you just like close it down and say, I'll go raise capital. I don't care about the numbers. So, I mean, there's people react differently to it. And so what I do is I go through all the terminology. I tell my students or my clients what each thing means, how is like how it pertains to certain situations that they're in, and how to move forward in certain directions. So, so that's what I can do. Um, and then, like I said, just as for NOI, net operating income, everybody really knows what that means, but do they really know what it means, or what does DSCR mean? So, I mean, I go through everything. It's like step by step. DSCR is debt service coverage ratio, which is basically your NOI over your debt service and how much more per month you're going to be making. So that's what I do. Anytime I come up with some alphabet soup, I always take it back a step so that you know what alphabet soup I'm referring to. So,
So let's talk about underwriting more, right? Because you're to your
yep.
point, there's different models that are out there. There's certainly the different initials and abbreviations, which when I left corporate America, I thought I was leaving a lot of that behind, and I was like, oh, this is even worse than commercial real estate. So to your point, your DSCRs, your NOI, your all of these different things that are out there, but all of them are really just trying to help us understand the health of an investment opportunity, right? And whether or not this is going to be profitable. Let's jump there because there's different models that exist. Can you talk about what people should be looking for before they select a model that they want to use to underwrite multifamily deals?
So, um, as an underwriting consultant, I get a lot of people who bring me models. I have just about all the major guru models out there: Michael Blanc, Joe Fairless, Rod Leaf, MFM. You name it, I probably have it in some form or fashion. What I've seen most is people get a model, they don't really understand how to use it. They fill in some numbers. They think that they're doing what it says they do. Maybe they watch like a 30-minute video on how to fill it out. But honestly, a 30-minute video is not enough time to figure out how to fill out a model accurately. Um, I've had people send me a model, say, "Hey, can you go over my model for me? I think this looks really good. My coach says it looks really good, and we're going to move forward. I just wanted a third party set of eyes on it." I tore it apart, and I noticed that they were triple dipping their rent increases on day one, and and they thought everything looked good, and they thought they were doing everything right, but they didn't realize they're going from say 550 a unit up to almost like 1750 a unit. They didn't even realize how much they were increasing it. They only meant up to go up to like 750 or something like that. It was crazy, and then they had no clue. So I mean, I tore everything apart and walked them through it. So yeah, I go through all the models. I go cell by cell. It's like a choose your own adventure where you go from one cell. It's like this formula says, all right, I go to this cell and this tab, and I go from this tab and this tab, and I go through all of them to make sure they're doing what it says it's supposed to be doing. So
Can you explain that part a little bit? Because I think that's interesting, right? You talked about that example. Someone brings you a model, they've looked at it, their coach looked at it, they're ready to move forward. They just so happen to want a third set of eyes, and you're finding some pretty huge issues when you talk about they're triple dipping on the rent increases. How does that even happen? I mean, is that a typo or did they mess the model up? Like, how does that happen?
so they added in the difference. Well, first, so you have like your current rent. So I got that from the T12 in the rent roll. The T12 is your trailing 12-month profit and loss statement. And so I see what the current rents are, and I see what they're bumping it up to, and they already increased it internally. They bumped it up to like 750 or whatever. And then they were increasing it again as the rents increased. And they said that was going to happen on day one instead of like over a period of 24 months. So that's the double dip there. And then the third dip, I forget exactly where it was, but it was somewhere else I found that it added it into it. And
Yeah.
it was like, wow. So, and it might have been like 550 up to 1100 or something. I think it doubled the rent, but I mean, the increase was like, it happened three times.
Yeah.
They didn't believe me when I pointed it out to them. And I was like, okay, well, I mean, that's your deal. You're under contract with it and you're about to close. And I'm just telling you what I'm finding. So the numbers don't lie in that regard. So
Yeah. I think it's crazy that, when you're underwriting, a lot of folks are relying on that model to tell them whether or not this is a deal, whether or not it's going to be profitable, what kind of returns investors can expect. And if there's a mistake or a bad assumption, it can throw everything off. Can you give some guidance to what folks should be looking for in the underwriting model so that they have, maybe a little bit more clarity of how to use it, what to look for, and where maybe there's some common mistakes or common areas where you see these models breaking down?
so if you're used to spreadsheets or like spreadsheets, I say dig into them and tear it apart. If you can, create your own. Um, I've created my own model. I did it from scratch, and sort of it's been evolving over the last 7 years. Anytime something new comes up, I add it into it. But yeah, just dig into it. If you don't like spreadsheets, find somebody who does and have them dig into it, or you can call me and I can help you dig into it. But a lot of times people are filling these out and they're just trusting numbers from either from their guru or from an OM or from the broker or seller. And so they're using those numbers to put into the model, and they're not even verifying that they're actually viable. I mean, the seller and broker have an interest in selling the property. They don't care really what happens after it's sold. You, on the other hand, the buyer, care everything about what happens after it's sold. So you can't just trust what they're saying. So, and if you ever look at an OM, the fine print on the bottom of it says, "Don't trust any of these numbers. Do your own due diligence and stuff." So, I mean, yeah, dealing with brokers is a whole other thing.
So, Jason, I always look at it from really three buckets when it comes to underwriting, right? And I would love to hear your take. I look at it as the model, right? So, the model itself, and how that model works. The second is the input. So typically your trailing performance, the T12, the rent roll, but what inputs are you putting in there? And then the assumptions, right? And this is where I think so many people get caught up is what assumptions are you making as far as either rent growth or what you're going to do to the property, the renovation budget, things like that. As you approach it, how do you break down underwriting from your standpoint?
Actually, that's pretty good for what I do. I never really thought about it that way. Um, but my model, so a lot of models they have like current rents you get from the T12 and rent roll, and then they have like market rents, and this is where you're going to increase whatever. But what I do is I break it into three different parts. I have your current rent, which is whatever the existing leases are. And then I take what the market rent is from that property management because a lease signed 11 months ago is going to be different than a lease signed next month, or hopefully should be. And then I have like my pro forma or comps rent. So then you can start using your assumptions on what you can increase it to and stuff like that. So that's how I do that. I haven't seen any other models do that. That way you can keep track of the current path it's on if you're not involved, and then you can see the current path it's on if you are involved. So that's how I do it. Um, but regarding my assumptions, I never come up with those on my own. I always have a third party verifying what they can be, a third party who's vested interest in it, say like a property management company or a tax consultant or insurance broker or lending broker or whatever. I have all these contacts I can call on for that specific property so that we can know what we're doing moving forward. So,
That makes a lot of sense, right? You're talking about not just putting numbers in that you believe and not even just trusting the brokers or the owner's numbers, but really getting that property manager, the tax assessor, the folks who are going to help you execute. You want to get buy-in from those individuals. And so many people don't do that. And I remember, one of my very first deals, we were, kind of into our due diligence period, and I hadn't gotten some of that buy from all the partners just yet, all the not partners, but stakeholders, right? And
mhm,
you need that because ultimately, if you're going to have a business plan and you're expecting your expense ratio to be in a certain range and you're expecting your property manager to, you know, do certain repairs or keep the budget in a certain line item, well, they need the ability to say, yes, that makes sense. And yes, we can do it. If they knew from day one that there was no way they could ever achieve what you were underwriting, well, you're DOA from the jump. So you definitely want to make sure that from a business plan standpoint, those key stakeholders are bought in, they're giving you feedback. Because they're going to be the ones who you're going to hopefully hold accountable to actually execute.
yeah, yeah, that's 100%. And property management, they're going to have their key inputs, and property management can make or break the property.
Yeah.
So
Yeah.
if you can't find someone who can carry out your business plan, then your business plan's never going to go. So,
Well, let's talk a little bit more about what you're doing with, underwriting, and in particular, we talked about the challenge and mistake you found with that one client. What are some red flags that really people should pay attention to if you see these?
right, so I sort of alluded to one of the trusting but not verifying. So that's one major red flag that I see. Another one that I saw, and this was more that I saw like a few years ago, back when we were in the height of everything, right before interest rates started climbing. And this was using the temporary trends for long gain. So I don't know if you invest in San Antonio or Phoenix or Austin, but in 2020, 2021, those they were seeing double digit rent increases
Mm,
every year. I've had numerous people buying properties in San Antonio, and yeah, they had 30% rent increase for a couple years. They were projecting that over 5 year for a 5 year hold.
oh my.
Yeah. I pointed that out to the client and they said, yeah, that's what they're getting. So that's what we're underwriting to. You have to be aggressive and to win deals. Is like, Well, I don't know if you know what happened in like 22, 23 time, but those rent growths were actually going negative, and they were having decreased rents because they couldn't keep people in. So, um, another one is arbitrarily following a guru. Um, there's a lot of coaching programs out there, and like some of the ones that's like, yeah, this underwriting looks good because they look at like five underwritings in an hour, and they're like, yeah, this one looks good, and they do some checkpoints and say, yep, it looks good, go off and buy it. And so they don't really understand what that guru is saying, or the guru doesn't even understand what they're saying. They might not even, I mean, I doubt they have a vested interest in that property doing well. I mean, they collected their coaching fee, and they do some quote unquote coaching, and then they send them on their way. So a lot of times coaches don't have your best interest at heart. Some of them do, some of them don't. So, um, and then another red flag that I sort of alluded to is just blindly putting numbers into a model. Um, like you don't know what these numbers mean. You watched a 30-minute video on YouTube on how to fill this model out. And so you think you know what you're doing, but you don't really know because you don't know how the cells interact with each other, if some cells are dead or not. Um, a lot of times I'll see models from like Michael Blanc or Rockleaf or whatever, and yeah, the model came from them in pristine order, but after it's been handed down like three, four, five different people, um, things have changed, and so a lot of times there's dead cells. I've seen people try to put in rent increases and nothing changes because the cells have been disconnected. And so it's like you need to make sure you're using a good model, a pristine model, not just regurgitating one from a previous project or property.
Yeah, those
Um,
are those. Oh, go ahead, Jason. Sorry.
no, no, no. I was about to jump into the next one, but if you
No, I was
mind
just
me,
gonna say, I think that's such an important point. Like literally, I was talking to one of my clients yesterday, and she was underwriting a deal using the model that we provided. And to your point, like what happens sometimes, especially if someone's not that comfortable in Excel, right? And she's a physician by trade, so she sent it to me, and I'm looking at it, and I'm like, well, you've overwritten like a lot of these cells now. So it's not updating and all of the formulas are gone. So it's like we can't make any decision on this deal. We've got to really go back and almost re underwrite the deal because the model has been broken at this point. So it does make, if you're not aware, if you ever see that, REF, that's a good sign that you messed something up there in the model, but also just understanding like, hey, understand the model, make sure it works, but also make sure you don't break it. Make sure that
yeah,
you have the right version of it. It's all working together, so you can get the information you're looking to get.
yeah, yeah. One thing that I do on my models is if there's ever a chance that someone can just like overwrite an equation, they'll like hard code a percent in or something like that, and it overwrites it. I always put like a comment, and that's that little red triangle up in the
Hmm.
corner that has the original equation in it. So if you ever lose it, you
That's
can at
smart.
least copy it
Yeah.
and put it back in. So I do that because even in my own models, sometimes I have to just do a overwrite, and I don't want it to calculate it because I know what it's going to be. So
Yeah. Yeah. Jason, you said a couple things there just to regroup on some of the red flags. You talked about one, making sure that you understand the temporary trends. And I like the way you said that because I don't think I've heard it phrased in that manner before. But your example is spot on, right? A couple years ago, rent growth was crazy everywhere in America. And in the Sun Belt states, I mean, it was 20% plus in those markets. And there were people who were underwriting with the assumption that that would continue for 5 plus years. And that was a temporary trend. But unfortunately, some folks were underwriting it as if it were the market norm. And now we're seeing, again, those markets in particular, the the rent growth has actually declined where rents have dropped. and they've underwritten to a 20% rent growth. And obviously, those deals are not going to be able to perform at those levels. So it's really important to understand that. The second one, we talked about the coaching, which I'm getting a sense, right? I'm getting an undertone, which probably isn't that much of an undertone, that you come across folks who go through different coaching programs and maybe aren't really getting the education that they need in regards to underwriting. So I'm not saying the rest of multifamily, but specifically when it comes to underwriting, and they're underwriting deals based on a model without really understanding the assumptions, without really understanding the model, and they're getting ready to make multi-million-dollar decisions based on this, which can be a little scary.
Yeah. Yeah. A large portion of my clients for my consulting and even my students have come from my students come from other coaching platforms, and they realize that they don't get the underwriting coaching that they wanted, and so they come to me for help. Those are the smart ones. The other ones, my consulting clients, they realized too late that they didn't get the underwriting coaching that they thought they were getting, and that's when they come to me. I mean, they've come to me like a week before closing, and it's like, can you help me make this deal make sense? Because we're closing next week, and we just learned our numbers are all wrong. And so I go through and I'll help them maybe adjust their capex budget, or that's capital expense where you do your renovations, or help them. It's like, well, you're probably going to have lower returns than what you projected, but let's see if we can at least get you in the positive return section. And so I'll help them go through there. We can find two things. Yeah, there is some manipulating you can do, but there's a lot of things that you can't touch and shouldn't touch because they're just outside of your control, and so you have to just deal with it. So
Yeah. No, I love that. And I know you got a free resource available. So if you go to ironcladunderwriting.com/masterclass, and then you get into some of these best case practices and some great lessons for our listeners as well, just to make sure that they're doing everything they can to identify opportunities. And if you go to ironcladunderwriting.com/masterclass, you'll get access to that great content there. Jason, I'm not sure where your thoughts are, but I'm a firm believer that there are going to be a lot of opportunities in the market, and being able to identify and analyze these opportunities is what's going to separate, folks who grow over this next stretch of the cycle versus those who maybe stay stagnant. What's your perspective in particular to, I guess, the shift in deal flow, opportunities, and underwriting as it pertains to the next cycle versus maybe what we've seen over the last, 2 to 3 years?
I have been seeing in the markets I invest in, I invest in my backyard. Wichita Falls, it's a tertiary market. No matter what any broker says, they'll say it's secondary, but it's not. Um, They are just now coming to the realization that their properties aren't worth as much as they think they are, and so they're starting to come down. Um, I had one property come across my desk earlier this week that's in pre-foreclosure. The owners are just trying to get out and pay off the debt and walk away, and so that's the nature of the market. Is I mean, there are a ton of foreclosures happening right now. With foreclosure, you're going to be looking at, can you get into some creative financing, or are you just planning on doing like your normal, I'm going to put down 30, 35% or whatever, or am I going to get maybe some seller carry back, or what? So, I mean, there's most of the models that I've seen cannot handle like creative financing. So my model I created can handle it. And if you have some creative financing that you need, I can create it for you. But you have to get creative now because deals aren't working the same way they were working 3, 4, or 5 years ago. Lending's not the same. You have to figure out your capex budget and everything else. So, I mean, there's a lot going on right now that if you can't underwrite it accurately, you're not going to be able to predict what the property will do. And again, that could get you into trouble if you're putting in some assumptions that may or may not pertain to this property or the situation you're in, and you think it looks good, and then you find yourself on another property that's on foreclosure. So, I mean, I don't wish that upon anybody. I do everything I can to keep mine out of that. So,
Yeah, I love that last point you made about making sure that we are underwriting deals the right way to obviously avoid catastrophe, but also that the next market cycle is going to have more deals that require creative solutions. And most of the models that exist are not built for creativity. They're built for a very traditional, straightforward, investment, JV, syndication, whatever, but they're not meant for the creativity and they're not built that way. So you're going to have to figure out how do you stack on these additional layers or put on these additional terms or these additional or different strategies. So you want to have a little bit of flexibility, and I know that's something that you and your team can help with. If you want to learn more, you can check out Ironclad Underwriting Mastery. The website is ironcladunderwriting.com, and again, the masterclass is there. We'll put a link to that in our show notes. Jason, we're going to transition and go to a round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the Mastermind button today. Okay. Give me a failure or an apparent failure that sets you up for later success.
So, and we're actually going through this right now, or we just went through it. Like I said earlier, property management can make or break a deal. We had property management. Our regional was awesome. Our on-site we thought were awesome. We brought them from another property to work on a problematic property we had. The problematic property went from like mid 80% occupancy down to like 76%. We ended up having to fire the on-site that we moved. The maintenance man got into drugs. His wife was the on-site, and so she was covering for him. They were pregnant. They just had no incentive or no sense of urgency to get the occupancy up. So we fired them. This happened in February. Our regional was sitting in the office and managed to get the occupancy up from 76 to we were pre-leased at 93% today. So that's 6 weeks happening. So I mean, property management can really make or break your deal. So, and you have to really vet property managers. We've had to fire some. We've switched property management companies. It's a pain, but I mean, you have to do what you have to do, and eventually we're going to bring it in-house, but right now we're still using third party. So,
all right. Give me a digital or mobile resource you recommend for our listeners.
A digital resource, go to my website, ironcladunderwriting.com. I have a 2-minute deal calculator there. I have that masterclass. I have links to my wife and I's community. My wife, Angel Williams, she has the Academy Presents community there. If you want terminology, we have all the terminology there, so you can type in a word that you don't know what it means and it'll pop up with it. So that's a good one. So
give me the book you've recommended or gifted the most in the last year.
I recommended Who Not How the most, but I've given away 10X is Easier Than 2X. It's both by the same authors, and Ben Hardy, but our whole philosophy is Who Not How. I'm the numbers guy. I deal with numbers and systems. My wife is the relationship one, so she deals with the people and raising capital. So we stay in our lanes. If we need help with something, we either find someone whose strength it is, and we stay in our own superpower. So Who Not How is definitely the way to go.
Give me a daily habit that helps you stay focused on your goals.
Oh gosh, I'm still working on that one. I am working on. I've tried journaling. I do it for like a couple months, something happens, and then I just don't do it anymore. So I've tried that. I definitely see how it helps. It keeps me task oriented on what I need to get done. And my journal, I also do like a gratification journal. So I'm like always keeping the mindset of being grateful for everything versus the negativity and everything. So I need to go back to that, and I would highly recommend that one. But I am faltering myself. So
Give me your number one insight for underwriting multifamily deals.
my number one insight, that's definitely get third party verification from a third party who will want to see you succeed, not from someone who just wants to sell a property.
All right, let's go in a different direction, right? You're in Wichita Falls. Give me your favorite place to grab a bite to eat.
We like Bricktown. I think there may be a couple of them, but we have one locally. They have like a really good barbecue chicken pizza. And when we were doing low carb stuff, they have it on a cauliflower crust, and you can't even tell that it's cauliflower crust. So it's definitely a good place to go.
All right, sounds like a nice option. Jason, you gave some great insights, talking about your background, bringing that engineer R&D lens to the table, and really diving deep into the numbers of underwriting and helping people understand complex data and understanding what those numbers actually mean. When it comes to underwriting, looking out for those red flags, making sure that we're not using temporary trends to tell a long-term story or making long-term projections, but also recognizing that people really have to understand the model, the inputs, the assumptions. What are they saying that they think this deal is going to do when they underwrite? If you're looking for help with that, looking for another set of eyes, Jason and his team can certainly help there. Again, we'll put a link to your stuff on the show notes there with Ironclad Underwriting. We just want to thank you again for being a great guest and coming on the show today. We look forward to staying in touch with you and hope you have a good day.